Okay, hello everybody. Welcome to Crane Atlanta Mentorship here with another Velocity Banking review. And you may have noticed that the title of the video is Velocity Banking and the Legend of Zelda. So you might be wondering, what do those two things have to do with each other? And I'm going to play a clip of Spaceballs to explain it.
Not so fast, Lone Star.
Helmet. So, at last we meet for the first time for the last time.
Before you die, there is something you should know about us, Lone Star.
What?
I am your father's brother's nephew's cousin's former roommate.
What's that make us?
Absolutely nothing, which is what you are about to become.
Yes. They have absolutely nothing to do with each other. And so the reason I made the thumbnail is because I recently beat The Legend of Zelda Ocarina of Time this morning. And hey, I have some free time because I guess I paid off some debt, right? In fact, let me go ahead and flex a little bit before we talk about debt payoff. I paid off a mortgage in 2 years and 9 months. Yep, that's what happens. You just pay off some debt and plays Legend of Zelda. And what do they have to do with each other? Absolutely nothing. All right, well, let's get started. Velocity banking, what is it? It's a debt payoff strategy where we throw all of our money into debt using something called a line of credit. And this time, we got ourselves into a good amount of debt: 7 credit cards, or 2 auto loans, 2 student loans, and a mortgage. And on top of that, we have $2,000 of expenses. So, first step to doing velocity banking is creating a budget, right? So it's really easy: income, expenses, your leftover savings, and then your expense breakdown. You list every single debt that you have, and then you have your non-debt expenses, which is your food, gas, insurance, and all that good stuff, right? So when we do velocity banking, we assume that we have the same income, right? Same income, same expenses, but really the difference, okay, the main difference between this and this column is what's the relationship between you and your checking account? Do you treat your checking account like the middleman, or do you treat your checking account as the final destination of your money? Right. So, a lot of times, if you say, hey, I'm not going to treat my checking or savings as the final destination and it's going to be zero, a lot of people freak out about that. Okay. Like, talk to any banker and try to get a loan and tell them, I don't have any money saved up. They'll be like, you can't get a loan, but magically you can get like credit cards and lines of credit if you have any money saved up. It's funny how that works, right? So we're not going to save any money. If you want to see how that looks like in real life, well, it just kind of looks like something like this, which is money comes in and then it just goes right out, right? $0 and then it just goes right out. And so what we're going to do is we're going to increase something called our cash flow, right? So the cash flow and the savings here in the velocity banking column are two different things because we're not saving money. We're not putting any money into our checking or savings, or at least we're not storing it there, right? So checking account is the middleman, whereas here the way that we traditionally think of a checking or savings is that it's the final destination, the final stop for our money, right? So that's really the main difference. And what we're also going to do is use our line of credit as our main operating account, right? So what's a line of credit? Well, it's basically a financial tool where you could borrow money, pay it back, and then use it over and over again. Okay, so like my home equity line of credit here, 373,500. So what does this mean? It means I gotta go to the bank's website, click a button, and then they'll dump up to $373,500 into my checking account and charge me an 8.5% interest rate. It's so easy, right? I'll just show you how easy it is. You just go to a bank's website and then you say, hey, I want money from a line of credit. And then I just select how much or go like to where I want to put that money from the line of credit. I'll say to the checking account, click transfer funds, and then they'll dump whatever amount that I put, like $5, $10, $1, right? So that's how this works. You just click transfer funds and that's it. Right. And so, a credit card is technically a line of credit, but you want to get the right tool for the right job and get as much as lines of credit as possible. So I have lots of credit cards. I have personal lines of credit. I got business lines of credit or business credit cards. I'll probably get a business line of credit soon. I might get the American Express business line of credit, which is not a traditional business line of credit. But I also get a home equity line of credit too, right? So 373,500, and then if I sum them all up, I have over $739,000 in lines of credit. $739,000. In fact, I know I use ChatGPT to ask like, "Oh, what percentage of people that I'm in?" But I'm interested to see what Google says. Google, because nowadays with Google search, it always pops up the AI. So let's go ahead and do that. I have over 739 K in, and let me put a dollar sign, lines of credit. What percentage of people does this put me in? And let's see if the AI generates. Okay. Top 1%, so a little bit different. Top 1%. That's what Google says. ChatGPT says top 0.01%. So whether it's 1 or 0.01, just know that I'm above the 99, okay? Top 0.01%. And so if you kind of, sum up all these lines of credit here, that's $739,000, okay? So here's a secret to getting all these lines of credit is that banks don't lend money to people who need it. And I'm not hiding back anything. The thing is that a lot of people are really bad at giving people what they want, right? So when a bank doesn't want people who need money, for some reason people keep going to a bank when they need money. And I got all these lines of credit when I didn't need money. I was like, oh, don't need money today. Don't need money here. Don't need money here. Don't need money here. And then eventually, over the course of a couple of years, I got lots of lines of credit, 739,000, right? It's just a mindset shift. Okay. Don't get the money when you need it. Because here's the thing, when you tell a bank you need money, you know what the bank translates that as basically you're not going to pay them back. Remember the time when your friends borrowed money from you and they said the magic words, it's because I need it, and then they didn't pay you back? The bank knows that too. That's why they don't do it. Okay? So, yes, I got all these lines of credit when I did not need the money, right? So, here's the thing, if you only have $98 left over, you're not gonna get a $260,000 line of credit, or it's gonna be very rare, right? Very rare, unless you have, like, significant collateral for outside of the traditional norm, you're probably not, right? And this is gonna be a $260,000 credit limit. Okay, $260,000 credit limit that we're gonna assume we have. And why do we do this with the free and clear, even though we probably won't get it? It's just because it makes the demo easier, right? It's kind of like telling someone, hey, if you get into a car crash and you didn't have car insurance when you crashed the car, think how great it would be if someone gave you car insurance after you crashed the car, even though you didn't have car insurance. That'd be amazing, right? That's why you get the car insurance before you drive. Same thing with the line of credit. It's pretty much the same thing, but a lot of people don't think they're too good for this. They wanna crash the car and then try to get car insurance rather than getting car insurance before they start to drive, right? But if you just had a free, clear line of credit, amazing things might happen, okay? Actually, I got texted. Give me one moment. Actually, that wasn't text. That was the, weather service telling me it's gonna be a sunshiny day, alright? So, let's assume that we have a free and clear line of credit. And then what we're going to do is move some of our debt into the line of credit. So we have, ooh, look at all this debt, right? So how do we know which ones to move in? And take a look at this student loan. It's $666. That means student loans are bad news, right? So, anyways, what was I saying? Um, Anyways, how do we know which debts to move? Well, we have something called the cash flow index, and it's really easy, right? You just take the balance of the debt divided by the payment. It's going to give you a number, right? It's going to give you a number, and think of this number as like a ranking system or a sorting system. And the lower the number, the better, right? Why? Because if you pay this big number off, that means you get little bang for your buck when it comes to paying off debt. I have to give someone $270,000 to only get $1,100 back in my cash flow. And sometimes what happens is that people get so excited about paying off the mortgage because it's emotionally tied to something personal, which is where you live, your home, right? Possibly where you grew up, if you inherited it, right? And so a lot of people really want to pay off that mortgage, but paying off that mortgage is inefficient because we have to give someone so much money just to get $1,100 back in our cash flow. Or or we could maybe pay this 30,000 off and possibly, I don't know, this 5,000, 35,000, and we get the same 1,100, right? So why not pay 35,000 to get $1,100 back in cash flow rather than this 270? See what I'm saying? So this is an easy way to kind of rank which debts to pay off. And I started to fall in love with this when someone gave me a spreadsheet through email, unsolicited, and said, "Hey, I have 22 debts and only $4 left over in savings." Right. And the reason that I actually covered that scenario in a 99-cent live stream, again, it's exclusive to 99, YouTube channel members. The reason why I did that, right, is because that person did most of the work. I saw the cash flow index, I saw everything, spreadsheets. I was like, you know what? I'm just gonna review it and see if I can, you know, give any insight. But I like it when people do most of the work, and all I have to do is just kind of add some finishing touches, right? I don't. You know what I really don't like when people just come up to me and say, hey, man, I'm not gonna do anything. I want you to do everything for me, and I'm not gonna pay you." I'm like, "Okay." That's like the same way the bank feels when you try to get money from them when you need it, right? Like, "Okay, buzz off." Anyways, alright, so alright, so let's go ahead and move these low cash flow indexes into the line of credit. So how much debt is that? Well, basically, that's 5, 8, 15. Whoopsie, I screwed up. All right. So 5, 8, 15, 27, 37, 10. And then I'm going to sum it up. And that's going to be $102,000 of credit card debt. $102,000, 102,000. Right. And so because we moved that $102,000 of credit card debt, again, this is not debt payoff, this is debt transfer. Okay. Guess what happens here? 0, 0, 0, 0, 0, 0, 0 for those 7 credit cards, and then magically, we went from $98 to $3,411.75, even though we didn't save any money, right? We didn't make more money either. So you tell your friends like, "Hey, look at me, I got all this debt, and I got $100 left over. Do I need to make more money to kind of, like, not feel like I'm drowning?" And everybody will say yes, right? Everybody will say yes. But now we kind of multiplied this by, I don't know, 30, 300. I can't even do math right now. I think 300%. And so let's go ahead and do this. And so now what we're going to do is we're going to put the final thing. So G2 plus H2 minus 3411.75. And so the final formula, I can't even think right now. Right? I can't even think. So so what you do is you add the previous one's balance interest and then subtract the cash flow because that's how much the balance will go down every single month. And remember, you put the entire paycheck. We're putting all of our money into the line of credit, and we're treating our line of credit. No, I'm sorry. Yeah, a line of credit as the final destination of our money, not the checking account, right? And so what we're going to do is do this average daily balance multiplied by the interest rate 0.08 divided by 12. That's how you estimate the interest for the month based on the average daily balance. And then let's see how long it takes to pay these credit cards off, right? And I'm going to zoom out. Whoa, zoomed out a little bit too much. And then I'm going to copy and paste. And then we see that it took about 34 months to pay all this off. Sweet. 34 months. I'm going to write that as a milestone. And 34 months and how much debt. And then now we got the auto loans, the student loans, and the mortgage. And luckily we have these amortized loan calculators to figure out the current balance. So I'm going to go ahead and put, what was it, 34? Yeah, 34 months. So 34, and then here, and then just follow the same formula. Look at this cash flow index right here. So let's go ahead and copy and paste this and sum them up and see what the total value is, right? So that's 26,000. Okay, so let's go ahead and sum them up. And 26,000, and then we're going to move that into the line of credit. So I'm going to just do that right here. Bam, 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 bam. Plus 26083.93. Okay, and then this is going to be 00, and then we get an extra $1,000 in our cash flow. Easy. All right, so let's go ahead and do that. And then this is going to be minus 4460.23. Yeah, and then in 40 months we paid off the 2 loans, the 2 auto loans, so that's gonna be 40 months. And then that's gonna be 102 plus 40 plus 17, and then 159K. All right, so now student loans and mortgages and all right, so this would be 00, and this would be 40, 40, 40, right? And then we have, okay, so we have here is 7% loan, 6%. Okay. And what I'll probably do is, if I were going to do this in real life, I'd probably do chunking on all of them, but I'm going to be a little bit lazy. Okay. I'm going to move these debts into a line of credit. So what I'm going to do is take this highest one here, lowest balance, and then move it into the line of credit. Okay. So one thing that you really have to be careful of that a lot of people don't really explain is that if there's a difference between the loan interest and line of credit interest, it doesn't mean that you can just move the whole loan into the line of credit. And this is especially true with whatchamacallit, the 30-year mortgage. All right, so 4808 456. And then I'm just going to do this right here. So let's see what. So 808.56. Yeah, let's go ahead and do that. And then we see that in 45 months paid off. Sweet. Okay. So 45 months, we paid off that loan. And then that's going to be 189K. And then the next one is in 45 months. What's the balance? This one is 0. So 45 months, that's the balance of this one. And, I'm not a preacher or anything like that, but I feel like when I'm eliminating this debt, I want to say "devil be gone" to the student loan. You know what I mean? I think it's a sign when it's this number and it's associated with student loans. In fact, let me just look up. Student loans are the devil. I'm pretty sure someone has written that. Loans are the devil. Yeah. uh. The debt devil. After 23 years, I'm finally free. 23 years for a student loan? Holy balls. Student loans are horrible and evil. Dave Ramsey. Oh, I agree with him there. Yeah. I'm pretty sure the reason why they don't teach finance in high school is that it's really easy to get an 18-year-old loaded up with debt with no idea what they're doing. And because it's guaranteed by the federal government, nobody really has to take any responsibility, right? Kind of sad. It's yeah, it's like the blind. I don't know if you would say the blind leading the blind, but kind of sad what the situation is. Anyways, 45 months, and that is, we'll just move this one into the line of credit. Whoopsie, what did I move here? Oh no, this one. That's what I'm doing. All right. So moving this loan into the line of credit, 1575.17, and now we get this unholy amount of cash flow, and now we are really rocking more than $5,000. Love it. All right, so now it's 55474.68. And then, bam. All right, so 53 months. We're good. All right, 53 months. And then 189 plus 60, that's probably 249K if I did my calculations correctly. And so now at 53 months, so this is 0, this is 53. And then now it's time to pay off the mortgage. So we have two options. So one of the things I always want to warn you about is that if you have a 30-year mortgage with a low interest rate, you don't really want to move it into a line of credit that's like 8% or more. And the more there is in a difference in interest rates, so when you get to nines, tens, and especially like 18 and 30% interest rates with the line of credit, you're going to end up paying more than you have to. So let me go ahead and show you in this velocity banking calculator right here. So 243 777.28, 77777.28. And then this is going to be, did I do this right? I don't know. So let me just kind of show you here. So this is going to be 8613.01. 8613.01 is our income, $2,000 of expenses. Now, let's say we followed the internet's advice and moved this entire loan into the line of credit. I mean, looks impressive, 3.6 years, and we quote save $68,000 of interest, right? But what if we do something called chunking, which is moving a piece of the loan into the line of credit? So I'm going to do 9,000, right? So now you see how it turns to 13. And you know what's even crazier is if I use a 30% credit card to do this, I still pay less. Look at this number, 17 grand, 3.3 years, than moving the entire loan into an 8% line of credit. Okay. This is the crazy part. 37, you see that 37. So I could potentially save more with the 30% credit card than moving the entire loan into a line of credit. Okay. And I don't know why the velocity banking space kind of promotes this. No, okay. So what am I doing here? What I don't remember what I did. But here's the thing. If you move the 3% loan into 30% credit card, okay, you end up losing 378,000. Gotta be a little bit careful. You know, people say the interest rate doesn't matter because the loan is always better than a line of credit. No, that's not true. All right, so 10% here. If we go 11, you know, 13, 12, 13, 14. Look at that. After every single percentage jumps into interest, then the benefit kind of gets lost, right? Whereas if you just do like small chunks, you know, bam, make it make sense. I don't know. All right. Well, that's it for today, folks. 3.3 years. So let me go ahead and do that right here. So this is going to be 0, and this is going to be 45 divided by 12 plus 3.3. And then that's 7.5 years, 7.05 years. And we're debt free. Okay. Debt free. And so what did we pay off? We paid off 7 credit cards, 2 auto loans, 2 student loans, and then we got 1 mortgage. Okay. Actually, let me do this. 1 mortgage. And yeah, that's it. So I beat The Legend of Zelda Ocarina of Time. And if you don't know what that game is, it's classic from the N64. I'm not a big fan of the 3D Zelda games, but I think this one is probably the best one out of all of them because it's if you play modern Zelda games like on the Nintendo Switch, it's so open-ended and it's so big that it's so overwhelming that you have no idea what to do. Whereas you play Ocarina of Time, you know, it's very compact. It's a fun adventure. You get to play as both the child and the adult Link and then go back between times. So it's like a time travel um adventure, right? It's really fun. Whereas, man, I hate modern Zelda. It's not like I really hate modern Zelda games. Modern Zelda games like Tears of the Kingdom and Ocarina of Time, not Ocarina of Time, sorry. What was the other one that everybody was like really hyped about? Oh, hold on. The first Zelda Switch game, Breath of the Wild, was not really that fun for me, even though I beat Breath of the Wild. Like, I didn't understand the story. Okay. But yes. So, what does velocity banking have to do with Zelda? Absolutely nothing. Other than I just want to tell you I beat it. All right. Well, have a great day, everybody. It's Curry Lance Mentorship. See you all in the next video.